So we got some short covering in GLD, about 500,000 ounces, 500,000 ounces short covering in GLD shares, specifically not in the futures market, but in the ETF. And I will show you how I know this. Silver premiums are finally down to pre-silver squeeze levels, or not exactly pre-silver squeeze levels, but normal levels that do not indicate any specific demand for physical silver by stackers or any stress in the physical markets, which indicates to me that the stackers are asleep at the wheel and nobody is believing this reality. They do not trust it, which means there is a lot of room to go on here. The proverbial wall of worry, the silver wall of worry in this case.
In today's market recap, silver price forecast facing downward pressure under 2480 time to sell. Silver's market dynamics have shown vulnerability with the commodities price at 24.55, reflecting a cautious stance from investors. Let's take a look at the impact of recent U.S. economic data. Unemployment claims remained stable at 210,000, suggesting labor market resilience. Philly Fed Manufacturing Index turned positive at 3.2 against an expected 2.6, hinting at manufacturing sector health. Flash PMIs for manufacturing and services outperformed forecasts with readings of 52.5 and 51.7 respectively, indicating economic robustness. Now we'll show you more clips of Rafi, but first hit the like button, subscribe to the channel, and check our pinned comment. Enjoy the video.
First slide here, we have some short covering in GLD on March 17th. I'll use these charts to explain how I see that, how I know that. I don't know it for sure, but it really looks that way, and I'll explain to you why I think it looks that way. So we have here a chart of gold shares, GLD shares. This is not futures. This is the ETF, specifically GLD, no other ETFs. This is only GLD. So we have the total metal in the trust, and we have a huge influx of gold here, about 500,000 ounces. This is from the day after. This is 0.05 million, so that's 50,000 ounces, but the day before was 500,000 ounces. This blue line here going up, and the gold stocks increasing in the ETF. So we see here that a lot of gold went in, but what do we see on the next chart? So that is transparent gold holdings, total transparent gold holdings in all gold funds across the board that we know about. On that same day, March 17th, this circle here, we see the bar was about 450,000 ounces or so. So all of maybe 430, it's hard to eyeball it. It's whatever, it's less than 500,000. So we had 500,000 ounces in on GLD, but only 450,000 ounces in on the same day across all gold funds, including GLD. So that means all the other funds, including the ETFs, including COMEX, including all the paper funds, unallocated, allocated, whatever, taking that all into account, gold only flowed into these funds to the tune of 440,000 ounces. If you take away GLD, gold holdings were down about 50,000 ounces, excluding GLD, which means the only one that flowed in was GLD. It looks to me that there was a whole big short position in GLD that was being covered, and when you cover a short position in GLD, you have to put gold back in, especially if you are doing it in a basket size, which you would if it's 500,000 ounces. If this were retail demand in gold funds, we would have seen other ETFs and other gold funds increase holdings. We did not see that, so I assume this is short covering. If it's short covering at a loss because GLD is at an all-time high. Premiums finally down to normal levels. It's a discouraging sign, but it's also an encouraging sign because it means that there's a lot of fuel left to fuel this market because the stackers are not participating in this yet. So I have here the red line of where premiums have been historically. This is where we are now, 10.67%. This is junk silver coins. And we have here, this is the same premiums we were at during the 2014, 2015 near bear market bottom in the silver market. And it was the same around here in 2021, just around when silver squeeze started, but before it started to really take off. If you can hear my chickens in the background, I'm sorry, I think they're laying an egg here. So we have a history of managed money longs. This is the COT charts. I put a bunch of rectangles here. I'll explain in a second. So we have here on the top here the gold price in US dollars, and on the bottom we have gold, COMEX gold futures managed money long positions minus COMEX gold futures managed money short positions. So basically the net position, the net long position, net long or short position by the managed money, by the hedge funds. So we see here these rectangles, okay? This is where we are now, 141,000 contracts. This is historically high. It's high, but it's not historically high. And we see here in the first rectangle, we were consistently above this level here, just above this level. And this was like the support level for open interest in the managed money. So this is basically how much hedge funds are long gold, how much they're speculating. So we saw here from about 2009 to 2011, during the gold top in 2011, we were consistently above this number, which meant a persistent bull market. This was a huge gold rally. And here at the top here in 2012, when the bear market really started, we just got up to the level, but we didn't quite break it. And now here we see the bear market. We were consistently below this level in open interest for the managed money longs, for the hedge fund speculative long positions. And we could not break that. We tested it right here, but we kept falling in the gold price. And silver is also obviously reflects gold here. And we see here, we broke through it once here, and we broke through it once here in this level, in this little intermediate top here. And we've been below that level in open interest since 2020, since the gold top in 2020, right? Gold top in 2020, we were above it. And now we've been below it for the last 4 years, but we're touching it again. This is the third test of the managed money long net positions. Are we going to break through it? If there's going to be a speculative fervor in gold, especially in the futures market, we will. And we could see the same conditions we saw here from 2009 to about 2011 in the gold top, September 2011. And we should see a very similar price action to what we saw in 2009, 2011, but I think it's going to be more extreme because the dollar is in a much more precarious position than it was back then.
Now, in the continuation of the episode, Rafi highlights the current situation of the international markets and ties everything up with gold and silver. Watch the video to the end so you get to know Rafi's prediction for 2024. Subscribe to the channel and take advantage of our sign-up bonuses with the most sought-after venues if you're planning to add crypto to your commodities portfolio. Let's get back into the video.
I want to go into cocoa for a second, not because cocoa is related to gold directly in any way or silver, but because it shows you what a short squeeze in the futures market really looks like. Okay, so we have here, this is an all-time high in cocoa. Forget about the market reasons why it's happening. I don't know much about cocoa markets, but I'm assuming there's a shortage in cocoa or something. So we have here the sign, please don't do cocoa in the bathroom. Somebody sent that to me on WhatsApp, so I figured I'd share it here. It's very, very relevant. And we see here, this is the managed money long positions here. They're also speculating long on cocoa. So we were at an all-time high here. The hedge funds don't always get it wrong. They got it right here. We were at a high here. I'm not sure if it was an all-time high. I didn't look at the charts, but it was a high, definitely a local high of about 80,000 contracts. And now they've been covering, or they've been selling into this rally. And the producers down here, we have in the red. I checked that to make sure this was red with my wife, who is not colorblind, but I can't really tell the difference. But I'm assuming she's not trying to make me look like a fool here. So let's just hope she's right and that she's not trying to make me look stupid. So 46,500 contracts short. And the producers have been covering their short positions since this short squeeze started. So it's the producers of cocoa that are in a short squeeze. Right? This was very reminiscent to what happened in the nickel market March 7, 2022, when this huge nickel mine company was short nickel, and there was a short squeeze. So even though it was a nickel mine, it was going bankrupt because they had margin calls on their short positions. I suspect the same thing is happening to cocoa producers now. They're in trouble, and they got to cover their shorts here, and they're hedging. It's dangerous to be short to hedge in these environments when the dollar is dying, because it will kill your finances no matter who you are. But you can't not hedge, but you can't. It's an impossible situation for producers of anything, especially when all the derivative markets are going to explode. So this is basically what we see as a short squeeze. The COT is narrow and the price goes up. We're not seeing that in gold yet. We will eventually, and that will be the signal of dollar death. The yen. I wanted to go into the yen here. So the yen is falling again, and I've been saying this again and again. The yen is going to fall as interest rates rise, because the yen is the Japanese bond market, because the Bank of Japan has acquired about half of the Japanese government bond market. So if the yen is the liability and the bond is the assets, they are the same thing. And as the bonds go down, the yen goes down. So raising interest rates in this mechanical sense is going to increase prices, because the yen will fall in dollar terms as interest rates rise, as we just saw when they rose interest rates and the yen collapsed to a triple top here. And a top means a low because it's 151 per dollar. So the higher this number is, the lower the yen is, and we're at near 1990 support, which I believe is 158. Once we break through that, we're basically in space here, and the yen could totally collapse. I just wanted to show here that 46% of the yen is in government bonds. So we have here the Japanese government securities on the Bank of Japan balance sheet. So let's just say 600 flagrillion here, whatever that number is. This is a unit in thousands of yen. So I think this is a 600 trillion. And the Japanese national debt is, I think, 1,300 trillion. So that's 1.3 quadrillion yen. These are all normal numbers. Don't freak out about them, and whatever. Yeah, that's inflation. So this is why I just wanted to show how the yen moves with bonds, meaning if bonds go down, the yen goes down. If bonds go up, the yen goes up. So the blue line is the 10-year yield. As this blue line goes up, that means that bonds are going down. Right? If bonds are going down, this line goes up, means the yen is going down. The higher this number is for the red line or the green line or whatever color that is, the lower the yen is. And we can see these things basically move in tandem because the yen is the Japanese government bond market. That's what happens when you buy too much debt. Money is debt. It is that way. It doesn't start that way, but as the fiat system decays and progresses, money and debt become identical. Now, this is I don't understand how trading economics can make this mistake. This is a page from the yen page of tradingeconomics.com. I don't understand how they made this or why it's still there. I just checked it this morning. This mistake is still there. So this is the yen again here. As the higher it goes, the weaker the yen is, right? If it takes 140 yen per dollar, the yen is stronger than if it takes 151 yen per dollar. And they say here, the Japanese yen strengthened past 151 per dollar, rebounding from 4-month lows as the dollar weakened after the U.S. Federal Reserve reiterated expectation for 3 interest rate cuts. What the hell are they talking about?
What the are you talking about?
What the are you here?
What the
are you talking about?
What the are you talking about?
This means a weaker yen, not a stronger one. You got to be careful of these economic sites because I think maybe they're written by AI or artificial stupidity. You can't really trust anything anymore that you see. I don't even know how I'm making these silver reports. I could be AI. Who knows? So I just wanted to go over this chart. This is the gold relative to the CRB index. Look at this. So everybody thinks we're in a gold rally. Oh, not really. We're in a commodity rally. This is a commodity across the board rally because if it was a gold rally specifically, gold would be outperforming commodities, but it isn't. This is the gold to commodity ratio. So we see we're at the same number here as we were in 2023, the same number we were here in 2020, just prior to the all-time high when oil went to like negative $35 a barrel. And we're at the same numbers here as we were in early 2016 when the bear market ended. So no, we're not in a gold rally yet. In dollar terms, yes, but in commodity terms, no. Just wait until we're in a gold rally in commodity terms and dollar terms. That will mean the dollar is dying. And mining stocks, going back to Fortuna Silver Mines, our sponsor, FSM, for this week's silver report. Mining stocks are in a perfect triangle that looks about to blow out or break higher. The higher this is, the higher that gold stocks are relative to the gold price. We've been in an ascending triangle since the bear market bottom at the end of 2015 here. We're going to break out of this triangle right now. I don't know for sure if it's going to be right now, but we're testing it again here for the the fourth time here since 2020. It's going to break out. It's going to break out to the upside. And when it does, gold and silver stocks are going to zoom. And this is not advice. Keep on stacking till the end.
What do you think of Rafi Farber's take? Do you think this time is like the past? Post your answer in the comment section down below. Subscribe if you have not yet done so. And watch this video right here because you'll love it. I see you on the other side.